Good day, everyone. Welcome to Fundamentals of Accounting. This is Mr. Alan M. Hadormeo. For today's discussion, we are going to talk about Introduction to Accounting. And for this lesson, we have four specific objectives or lesson objectives. First, we're going to define accounting. Second, we're going to describe the nature of accounting. Third, we are going to explain the function of accounting in business. And the last one, we are going to narrate the origin of accounting. Let's get started. What is accounting? Accounting is a process of identifying, recording, and communicating economic information that is useful in making economic decisions. Why do we need accounting? Why business owners, managers, top management should consider accounting? Because it is useful in making economic decisions. Every now and then, business owners, management, top management need to make a decision. In accounting, the output in the accounting process, the financial statements, is a good help or useful as they make economic decision. That is why we need to have accounting. Now moving on, we have three essential elements of the definition of accounting. But before that, let's read again the definition. Accounting is a process of identifying, recording, and communicating economic information that is useful in making economic decisions. So the three essential elements in the definition of accounting are identifying, recording, and communicating. Let's discuss one by one. First is identifying. What is identifying or classifying? The accountant analyzes each business transaction and identifies whether the transaction is an accountable event or non-accountable event. This is because only accountable events are recorded in the books of accounts. Non-accountable events are not recorded in the books of account. Now, the question is, what is accountable events? Accountable events or economic events are those that affect the assets, liabilities, equity, income, or expenses of the business. Again, it is of the business. Sociologically or sociological and psychological matters are outside the scope of accounting. Now, let's discuss further accountable events by giving example. Example, you have a laundry shop. And in your laundry shop, you purchase additional 2 washing machines. And each cost 50,000 pesos. You use the washing machine for the business. The question is, that business transaction, the purchase of washing machine, is it a countable event or non-accountable event? The answer is, it is a countable event since it affects the assets of the business. When you purchase washing machine, there is decrease of cash and increase of machinery or equipment. Because accountable events are those events that affects assets, liabilities, equity, income, or expenses of a business. Now let's have another example. You have a laundry shop. Okay, we stick in the laundry shop. And you are the owner of the laundry shop. You purchase a washing machine that you use for personal or use it for personal use, or you purchase it for personal use in your home or in your house. You purchase it for 50,000 pesos. The question is that business transaction or economic event accountable event? The answer is no. It's not a countable event. Why? Because it does not affect the assets, liabilities, equity, income, or expenses of a business. Remember, you purchase it for personal use. It's not for the business. So the business has nothing to do with buying that washing machine. So the business will not be paying it. The business will not be using it. So it is outside the business. That is why it is non-accountable event. Because again, accountable events or economic events are those that affect the assets, liabilities, equity, income, or expenses of a business. The second one is recording. The accountant recognizes or records the identified accountable events. This process is called journalizing. So after we classify, after we identify, we now record it. We now record it in the books of account. After journalizing, the accountant then classifies the effects of the event on the accounts. This process is called posting. Account is the basic storage of information in accounting. Example is cash, land, sales, etc. The third one is communicating. At the end of each accounting period, the accountant summarizes the information processed in the accounting system in order to produce meaningful reports. This is important because information processed in the accounting system is useless unless it is communicated to intended users. Now, this essential element of the definition of accounting is very important. As what I've said a while ago, as we define accounting, we have accounting, there's process in accounting, and we have output in accounting, and that's a financial statement because it is useful in making economic decision. Accounting information is communicated to interested users through accounting reports, the most common form of which is the financial statements. So the financial statements must be presented, must be discussed to the decision makers, to interested users, presented to interested users, or available to interested users, so that that information will be communicated to them, so that they will be informed on those information. Why? So that they can come up with a decision. Because the financial statements, the output in accounting process should be helpful in making economic decision. Now just take for example in a personal level. For example, Lee Plaza will have a 90% sale. Oh, just imagine it's 90% sale. It was posted on their official Facebook account. Here it comes. You are going to Lee Plaza and you are going to buy something. And that certain item on next week's sale is actually part of the sale. And the question is, if you were informed that Lee Plaza will have a sale on item that you want to buy next week, 90%, that's a big discount, will you buy that certain item today? Probably not, because you are going to take advantage the sale that is happening next week. So that information has been a basis for you to postpone the buying of the certain item. That's how important it is that certain communication or information rather should be communicated so that it will be useful in making economic decision. Okay? So let's go back into the definition of accounting. So accounting is a process of identifying, recording, and communicating economic information that is useful in making economic decisions. That is why the nature of accounting is a process with basic purpose. What's the purpose? That is providing information about economic activities intended to be useful in making economic decisions. We have to put it in our mind that the output, the product in the accounting process should be useful, helpful in making economic decisions. Business owners, board of directors, top management do make decisions every now and then and every day. And the financial statements as product in the accounting process would be a good help, will be useful for them as they make economic decision. Now, let's have the functions of accounting in business. Accounting is often referred to as the language of business because it is fundamental to the communication of financial information. So, accounting is labeled as, or considered, or referred to as the language of business. Accounting has the following two broad functions in a business. We have to provide non-owners of a business with information that is useful in making, among other, investments and credit decisions. These non-owners, let's take for example, in your laundry shop, and you don't have enough money to purchase additional washing machine. So your option probably is to borrow in a certain lending company. But probably we have in business credit investigation, the CI, the credit investigation. Before that lending company can lend money to your business, the owner, the in charge would probably have to go through with your financial statement if you are capable on repaying your loan. Okay? So that's the first function, to provide non-owners of business which information that is useful in making, among other, investment and credit decisions, and to provide business owners and managers with the information that is useful in managing the business. So this the accounting information also is useful for them as owners as they manage the business, so that they will be able to come up with right and sound decision making. For example, your business already, you have a laundry shop, or let's stick with a laundry shop, and you are already having several customers, and currently you only have 2 washing machines. So as you come up, as you see with it that, oh, you have several, the data here, there's an income, a high income, and there's an increase of customers or incremental increase of customers. So probably you have to come up based on the information. You will be deciding to buy another washing machine in order to cater the increased number of customers. Now, there are 2 users that we have to differentiate: internal users and external users. I think the basic distinction between the two is the internal users. These are users that are directly involved in managing the business. Okay? Directly involved in managing the business. Example, business owners who are directly involved in managing the business, board of directors, then managerial personnel. While the external users, these are not directly involved in managing the business. Example will be the lenders, the suppliers, the creditors, government agencies, customers, non-managerial employees. So the distinction probably here is their involvement in managing the business. Internal user is directly involved while the external users are not directly involved. Next, let's talk about or let's narrate the origin of accounting. Accounting can be traced as far back as the prehistoric times, since the dawn of civilization when mankind began to engage in trade. Perhaps more than 10,000 years ago, methods of record keeping and accounting has been invented. As early as 8500 BC, accounting has already existed. Archaeologists have found clay tokens as old as 8500 BC in Mesopotamia, which were usually coins, discs, spears, and pellets. These tokens correspond to commodities like sheep, clothing, or bread. They were used in the Middle West in keeping records. After some time, the tokens were replaced by wet clay tablets. During such time, experts concluded this will be the start of the art of writing. Other ancient civilizations keeping accounts records are Babylonia, that is 4500 BC, Egypt 2250 BC, China, and Greece. In the Middle Ages, 13th and 15th centuries, trade flourished in places such as Florence, Venice, and Genoa. This has brought advancement in accounting keeping methods. In 11 AD rather, one of the systems in accounting was kept by a Florence banker. However, the system was primitive as the concept of equality for entries were absent. Double entry records first came out during 1340 AD in Genoa. In 1494, the first systematic record keeping dealing with the double entry recording system was formulated by Fra Luca Pacioli, a Franciscan monk and mathematician. The double entry recording system was included in Pacioli's book titled Somma di Arithmetica, Geometria, Proportioni, and Proportionista, published in November 10, 1494 in Venice. The concept of double entry recording is being used to this day. Thus, Fra Luca Pacioli is considered the father of modern accounting. All right. So for today's discussion, we were able to define accounting. We were able to discuss the nature of accounting. We also discussed the function of accounting in business, and we're able to narrate the history of accounting. So thank you so much for listening to our video discussion, and have a nice day.